Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is May Day, the 1st of May, the first of the second month of the second quarter, and Brent crude oil is trading this morning below $80 a barrel. It fell through the floor of 80 last week, recovered a little bit on Friday, but starts the week a little bit soft. Let's kick off, as always, on Monday mornings with Omar Najia, Global Head of Derivatives at BB Energy. Omar, your thoughts and outlook as to the direction of travel as we start the new week?
I think basically same. So we had since last Monday, we had the market move down, then move back up. So it's pretty much where it was last Monday. But I think higher. I basically think this correction is done. So I think you have to look at this market from the low that it set on the 20th of March, which was a low at about $70 basis Brent. So it went from 70 to 88 and now down to 80. Okay, so we think that $70 holds and market goes higher. So this is all a correction to the move from 70 to $88. So when, let's say, $20 up, it's come off $8, and we think the next move up is going to be, or the next move of consequence is going to be to the upside. Let's see what happens. But the more people are negative and China and all this kind of stuff, the more we like it. So I think as long as the $70 holds basis Brent, then higher.
$70 on WTI, you mean, in terms of the floor?
On Brent.
On Brent.
Brent. So Brent set a low at 70.17 on the 20th of March. It went to about $88 and came up from 88 to 80. So we think that move from 70 to 88 is the direction of the new trend. And then we've corrected that a little bit and higher again. We had a gap basically that was close. So we think higher.
Adi Imsirovic, Director, Surrey Clean Energy in the UK. I was going to say London, but it's not. Of course, it's Surrey. But Adi, your thoughts this Monday morning? We clearly have the big headlines of this week coming. Another Fed rate hike seems to be expected, and a consensus around that expectation. We just had some data out of China this morning with weaker manufacturing numbers out of China for the month of April. Your thoughts?
Yes, I mean, good morning, Sean. Good morning, everyone. The market in the last couple of weeks, at least, has been moving quite fundamentally. I think we had those surprise OPEC cuts, which OPEC themselves says were not really cuts; they were voluntary cuts.
And they weren't really OPEC either. So they
and they weren't OPEC; they were OPEC plus. But of course,
what was the phrase that Prince once used? Formerly known as Prince, formerly known as OPEC plus countries.
Exactly. So formally known, whatever announcements were, essentially there's very little evidence of anything going on, really, anything changing in the market. So markets really moved back to the fundamentals, and the fundamentals are not as bright. I'm probably not as bearish as Omar. I'm not quite sure the market will go all the way down to 70 before it picks up. But we're going sideways because there's so many macro issues out there. We've got, over the weekend, we've had actually regulators trying to arrange the sale of the First Republic Bank, and it should have been announced on Sunday, and it hasn't been announced, and that's not very bullish. We still have all these banking issues in the United States that are a problem, and on the top of that, this weekend, I think it was Saturday or Sunday, that Charlie Munger, the Warren Buffett's lieutenant, came out and said, well, US banks are full of bad commercial property loans. So that was, in my opinion, I think the market hasn't reacted as much as it should have. It's quite surprising. In fact, he's saying, well, we've got subprime, only this time it's commercial rather than residential properties. So that's not particularly bullish. Then China comes out, manufacturing PMI of 49.2. In April, a lot lower than 51.9 in March. Non-manufacturing as well below positive, in a positive territory. It's 56 point something, I can't remember, versus roughly or just over 58, but not particularly bullish. So we've got all these issues where the market, I think there was a Reuters poll on Friday that said about 2/3 of the economists consulted expected recession. So, none of it is particularly bright. So it's very fundamental. This market is kind of moving sideways and just waiting for the next move by the Fed, particularly comments. I think 0.25 quarter% increase is taken for granted. It probably will happen. But what are the comments of the Fed afterwards, I think are going to be very, very important.
Bill Spindle, Council on Foreign Relations, International Affairs Fellow in India. I think that used to be former, perhaps, but I'm not sure. But nonetheless, Bill, sitting in America with a front row seat today it seems to me that while China doesn't sort of reemerge as the dominant force in the energy markets, it sort of is maybe a neutral force. Then one turns to the US for direction, as this market seems to be, in the doldrums, if you like, a part of the ocean with which there is no wind, and that wind could come from the US, either positively or negatively, recession or more bullish outlook with equity markets that only want to go up. What's the perspective from the US, Bill, this morning?
Yeah, I kind of agree with what we've just been talking about. It's, the Fed's in a pretty tricky position with, both kind of signs of a credit crunch coming beneath the surface, this trio of banks that have failed. They still haven't, as we just said, I'm actually watching my headlines to see whether something pops up here any minute now about this First Republic, the third bank that they're trying to work through. But of course, that's what the Fed in a way has been trying to do, to try to bring inflation down. They've been trying to restrict, credit on some level. And that's, they're reaching the peak of that cycle, likely another small increase this week, but what happens after that? And that's the tricky line they're going to have to hold.
Omar, does the energy markets, the oil markets, a trader like yourself and all of your colleagues sitting behind you care about the Fed continuing to raise rates this week? Is it baked in already?
I mean, I think it's all news, right? So if everybody expects them to go 25 basis points, and then the money markets expects them to start cutting, right? That's all expected. If you look at fundamentals, then everything is death and destruction. But U.S. equity markets go up, right? But then,
there's still an ocean of liquidity from 10 years of quantitative easing. It will take a lot to push that back in the genie bottle.
Man, yeah, I agree. But what I would caution against is using fundamentals where you see, you say like, I don't know, Chinese are gonna get stuffed and I don't know what, and blah blah blah, and then you say that means that oil is going to go down, whereas equity markets are going up. So actually,
but ultimately, you would agree, Omar. I would think that in order for the second half of the year kind of bullish outlook that you have, it will require China coming back to something a bit closer to revving up the engines, no?
But I think China is coming back to a bit closer to revving up the engine. I mean, they've been declared dead so many times, right? I mean, first it was the what was it, the property stuff that they would never, it's going to be death and all the rest of it and blah blah blah. I mean, these things change month by month and day by day and hour by hour, right? You have to have an outlook. You have to have a reason for that outlook, or you can basically just follow the markets and or follow the news and say, oh God, the Fed just raised interest, say sell it, and then you wait a little bit and you say, well, now everybody's sold it, and I don't know, Elon Musk says buy, and everybody buy. So I think it's a little bit more kind of nuanced than that. So I would, the Fed raising rates is already baked into the price, right? A credit crunch is underway, which is a basic assumption. The banks in the US and commercial property, that's news from about a few weeks ago. So all that's known, right? The question is what is going to change what bit of something is going to change to make these markets either soar or dump. So basically what we have now is markets which have extreme volatility, right? We're seeing it in oil, we're seeing it in equities, we're seeing it in everything. And the reason they have extreme volatility is that it's like this turbulence. Sometimes it's, going up, going down, going up, going down. These are periods of indecision, and the markets are going to break these periods of indecision either to the upside or downside. So I think that basically equities in the US, equities in Europe are going to break it to the downside in a big way. But I also think that oil is going to break it to the upside in a big way. And people will say, oh, but if equities go down, then oil can't go up. And then I say, well, look at 2008 and look at 2022 and look at 2014. And we had equities go that way and oil go that way. So it's going to be really interesting.
Adi, one of the things I was thinking about over the weekend in terms of this sort of, if you like, stagnation to a certain extent and in the oil markets, and this kind of when all else is still, the natural tendency of this market over the last number of months has been to drift downward unless there's some ultimate identifying reason for it to go upwards. The natural resting posture seems to be downward. And I'm wondering, from your perspective, what role of all of these other pieces we talk about does the price cap have on that? We have a significant amount of oil being sold in the world today at what seems to be $60 or less. Has to be I would think, a natural downward draft on the average. I'm wondering, from your perspective, where is the dynamics of that playing into the overarching price of things?
Okay, Sean, before I address the price cap, if you don't mind, I'll just take one step back.
Please.
To address the point that Omar suggested. Just the reason for the equity market being where it is twofold. We've had very good earnings, especially in the tech sector, so that supported the market. The second reason is the inflation. So for an investor, it's a very tricky situation. What do you do with your cash? If you put money in your cash, you're losing, in the UK, 10% a year. That's not fun. You're basically trying to find defensive sectors and keep sort of the equities on, because at least companies most of the companies in the defensive sector have a chance of passing on their cost to the consumer. So, there is very strong reason to hold shares, okay? So now, going to the price cap, well, overall fundamentals, you're right. I mean, I've always argued the price cap, the only function the price cap has is to keep Russian oil flowing. Okay, that's a Biden administration idea. They want cheap gasoline. They want Russian oil to come out. And in that respect, sort of it worked, even though it didn't work really, because price cap was well above the market. We actually, when we crossed the price cap, excuse me, nothing happened. Okay, there was a bit of slap on the wrist, don't do it again kind of thing, and the market keeps going. So the Russian exports are continuing as usual. If you remember, Sean, when right after the Ukrainian conflict, i.e. Russian invasion of Ukraine, what we said was we were going to lose 2.5, I think IEA came out with 3.5 million barrels of Russian oil. And that's why we had these big spikes in the oil market. Right now, everyone's kind of realized that Russian oil continues to flow. We're probably going to lose, I don't know, maybe 500,000 barrels naturally because of the extension of these sea lanes going longer, and it's harder to load and it's harder to sell and move the barrels. It's not a big deal. There's plenty of oil out there. There's lots of oil out there. At the moment in the Mediterranean, for example, there's a little bit of pressure. I think Exxon has just lifted force majeure on because of the strike in Nigeria. And we've got oil flowing. US oil is coming to Europe in a big way. So the market is fundamentally well supplied. There's no reason for the market short term to go much higher. Now, again, where are we going from here? Are we going over 80? I still think that we'll go well over 80 in the second half of the year because of fundamentals. But then again, I've been wrong before. It very much depends on where we see the economy going. Economy going this year, according to IMF, at 2.8% is really, it's peanuts. And even the IMF in their financial stability report say the risks are on the downside. So I think the market is very, very fundamental. It's actually reflecting what we expect in financial markets. And if you just allow me to say one more thing, I was in Vienna last week with IEA OPEC conference, and the topic was volatility in financial markets, impact on the oil markets. And it's very fundamental. Financial markets do lead oil markets. There's no doubt about it. The flat price is set by sentiment, by fundamental expectations as per financial markets, not by the people who buy and sell physical oil. And at the moment, that's where we are.
Bill, the outlook in the U.S. at the moment, we've got the numbers for the first quarter somewhat lower than expected on GDP growth, but nonetheless higher than expected on consumer spending, which remained quite robust, upward close to 4%. What's the outlook, do you think, there for that divergence to continue as we sort of move deeper into this very political window in the U.S. Calendar?
Yeah, I think a lot of it depends on how determined the Fed really is to get inflation down into that 2% range, because they're really at a point where there's quite a bit more work to be done to get it there. But there are these banking issues that make a lot of people nervous, and obviously they make them even more nervous going into a political cycle like that. So I think it really depends on how far the Fed really wants to push this. Do they do, what like Omar said, do they actually go into a cutting cycle and sort of back off, even though inflation really remains pretty significantly above that 2% range, or do they keep pushing?
Where do you think, I mean, from your sort of outlook as to the growing noise around the debt ceiling fight, which is inevitably starting to rumble up now with the Republicans passing their bill in the House last week, Biden is ignoring them and doesn't want to negotiate around it, just basically a one-page upgrade or change to the debt ceiling. Is this something you think that could go into a very dangerous place, or is it just the same old story, lots of noise before the cliff edge and everybody backs away?
Yeah, well, it's harder and harder to predict, I think. I think by far the most likely thing is exactly what you said there at the end, that we get right to the cliff at the end, and there's a deal that gets constructed between some reasonable Republicans and Democrats to raise the debt ceiling, and perhaps there's some face-saving way Biden is able to negotiate a little something behind the scenes that kind of make both sides happy. That's the most likely outcome. But you really do have a group of legislators now in the House, a fairly large group, who are determined to keep pushing this right to the cliff, and you never quite know what could go wrong at the end.
Yeah, it certainly feels like this might be a different set of circumstances given the political backdrop and also the election cycle on the other side. Let's go to the survey question and get a view from the room on that as to whether this week's Fed rate hike is baked into the oil markets already. Probably is, but nonetheless, I suppose it does have a bearing perhaps on what the commentary, the press conference has to say on the outlook for that. Omar, in your technicals, you had said last week about the idea that if the market was to retest the low previously on Brent, technically, and you had identified that there was a gap there still. Have we broken through that? What does that look like now?
Yeah, we filled the gap. So I think that this is what this move is all about. So we filled the gap on Brent and WTI. And then we see what happens basically going forwards. But the thing, I mean, there's sometimes there's a big misunderstanding. So inflation is not good for stocks. And the problem is that inflation causes a raise in interest rates. So if you got money and you want to bet on you want to put it in stocks, if the rate of inflation is very high and interest rates are at 5% and US treasuries are giving you 5%, then most people would actually put their money in US treasuries because it's quote unquote risk free, right? So if you want to buy Apple or Amazon or Alphabet or Timbuktu, whatever it is, you should, if you're realistic or if you're planning to make money, you need that return to be multiples of that 5%, right? Which is why people are pulling their money out of equities. So what you're seeing in equities is you're seeing a rally that is not broad-based, which means basically that fewer and fewer names are going up and the rest of them aren't doing so well. So usually what you want is you want to have a broad-based rally because that's healthy. It's like, you know, in your community, everybody's getting richer. But if it's just one person getting richer, then that's not so great for the whole economy. So I don't think that, you know, interest rates and interest rates going up and inflation, that the solution for that is to buy more stocks. I think exactly the opposite. I think it takes money out of equities and puts it into government treasuries. But again, I think that if you look at consensus will tell you that not only are people expecting a quote unquote soft landing, that the people, the brains of the IMF are actually expecting a no landing. So basically we're not even there. It's like off we go and into the sunset, and they probably play some nice music. And I think that's totally delusional. I mean, I think that's we have a banking crisis. We have a war in Europe. We have the US and China about to go head to head. And basically these people are like, yeah, everything's going to be okay and we're going to grow and don't worry so much about the banking crisis and don't worry so much about inflation and we'll all get it under control. I think that's absolutely delusional.
It's just another weekend where a bank has to be bailed out. It's like, you know, you go to a football match on Saturday afternoons and you go watch the bank bailout on Sunday afternoons. Adi, I wanted your thoughts on this report over the weekend on Putin, his view backing away from the earlier move that banned Russian companies from exporting crude oil in compliance with the G7 price cap of $60 a barrel. Is this a big change of tack?
Yeah, thanks. No, it's not. I think at the risk of being a bit boring, Sean, I think, you know, this whole idea of price caps is just, there's a lot of politics going on. Of course, Biden administration wants the Russian oil to flow. Russians want the Russian oil to flow. Whatever they say, Russian cuts, it's just posturing for OPEC Plus. They're not going to cut. They're going to sell as much as they can. They need the cash. They need the revenue. And all of this talk by Putin and anyone else from his administration is just pure posturing. I think at the moment, everyone seems to be happy with the status quo, where Russian oil is selling at big discounts. And let's remember, Russian oil is selling at big discounts because of European sanctions. And the oil price cap is just negating those sanctions. So it's not because of the oil price cap. The oil has to move a long way and look for basically what I call bottom feeders for people who are actually normally not buying this crude, but will buy it at a big discount. So, you know, the West is happy with those big discounts, and the Biden administration is very happy with oil flowing. So gasoline prices in the US are not excessive.
Going into the summer driving season, of course, which is
the summer driving season started in a way because, you know, the market anticipate we are trading July gasoline essentially. So it's already started, but, you know, sadly, you know, it doesn't seem to be doing very much, you know.
Well, let's give the last word to Bill. I wanted to get your thoughts, Bill, on the geopolitical incident that happened last week in our region here. I know you're away from it at the moment, but nonetheless, there was a tit for tat around hijacking of Iranian crude oil by the Americans, and then the Iranians reacted another way. Your thoughts on where that all stands now, this sort of face-off between Washington and Tehran? Is it a big deal? Is it over? What are your thoughts?
Yeah, I think it's kind of more in the usual realm of things. You know, and the backdrop of this is still the Gulf states, the Gulf Arab states, and
Right.
Iran sort of trying to work through a little more stable relationship over the longer term. I think this is more of a blip in that larger backdrop, which is the more important change. And the direction we're going is a little more stability in the Gulf itself, though Iran, you know, continues to do what it does beyond that, you know, the rest of the Middle East, which is still going to be problematic.
Well, we'll leave it there with Brent trading at 79.70. Thank you so much, Adi Imsirovic, Bill Spindle, and Omar Najir for your thoughts this morning. We'll have to see if there's any breakout either direction this week. All the best, and thank you.
Thank you very much.